Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We've talked a lot lately about investing in large caps, the big companies that dominate the local share market. But there's always plenty of activity in the small caps too, across the full range of sectors. How do you go about finding the opportunities, particularly when new COVID strains and inflationary pressures are hitting markets? We always recommend that investors get their own advice, but it's also handy to hear the opinions of experts about where to start your research. Oscar Oberg is the lead portfolio manager at Wilson Asset Management. Oscar, welcome to Fear and Greed.
Yeah, thanks for having me, Sean.
Broadly, what's the outlook for small cap companies as we head into 2022, particularly considering all the supply chain disruption issues, COVID outbreaks, inflation, that type of thing?
Yeah, I think you've nailed it in terms of your summary. Look, it is a very tough environment for small cap industrial companies. And you're seeing a squeeze for both high growth companies and also low growth, say, call it cyclical companies. And, we're seeing since the US Federal Reserve signified that inflation was no longer in transition, with interest rates set to increase over the medium term, that this has really hits high valuation sectors such as the technology sector. But then you also, on the other side, you have Omicron concerns and also supply chain concerns, which are impacting more cheaper cyclical companies in sectors such as tourism and retail. But I guess within this backdrop, we're still very positive for companies, particularly those exposed to the Australian economy. We think the economy is doing very well at the moment. And we're looking at those companies that have the ability to push through pricing increases in particular to offset cost pressures. We also think this Christmas period for retail in particular will be very, very strong. And we're also starting to see green shoots in the tourism sector. And we think this will have a very strong 2022 and 2023.
Okay.
So a lot of the companies we're looking at have very good valuations that fit our investment process. So we're seeing a vast array of opportunities at the moment.
Okay, so let's take retail, for example. There's been a huge shift, or there was a huge shift during the pandemic. The Temple & Webster's, Kogan.coms did very well, though they've now fallen out of favour somewhat with investors. If I'm an investor, what should I be thinking about when I'm looking for a retailer outside Wesfarmers and Woolworths and Coles and those big guys?
I think in the way we look at it, it's very important to have a distinction between those companies that have been a COVID beneficiary. And I think, Kogan and Temple & Webster are two companies that certainly have. I mean, it was just a huge boom that we saw in e-commerce. But then there's also other sectors, homewares in particular. Some companies that come to mind are Adairs and Nick Scali. And just people being at home, spending more on their home. That's created a huge boom in homeware spending over the last 2 years. So those are the sort of sectors that we see as sort of the COVID beneficiaries. Now, they're still doing very, very well. A number of those companies have very strong balance sheets. But in terms of how we invest, we've shifted across to those companies that will benefit from a reopening of economies. And yes, there are concerns on Omicron, but the fact is that the vaccines do appear to be working. And, the early signs for Omicron are suggesting that it's perhaps a little bit milder than what we thought. So when we're looking at these companies, at retail companies, we're looking at those with big store networks. And we also think these businesses can also thrive as sort of shopping malls, in particular, struggling. So we think rents can decline over time. So some companies we're thinking there, or we're invested in within the portfolio are Premier Investments, City Chic, and also Lovisa.
Okay. And so Premier, of course, is Smiggles, Peter Alexander, Dotti, all sorts of companies like that. Okay, so then you mentioned travel and tourism. Again, if we go to the travel companies and we think of the flight centres and the Webjets and that, they've run reasonably hard already. Is it too late to jump into those sorts of companies, or do you think there's more to go?
Well, we think there's more to go. And I think, it's fair to say we've had a bet on travel within the portfolio for at least a year and a half now. And, I think there was a few sleepless nights of Wilson Asset Management over the last 2 or 3 weeks when we heard of the Omicron variant come through. But I guess, look, there's always opportunities in this sector. And I think, given the noise and I guess all the information that we're hearing about COVID, there's, you have periods where the share prices take off,
Yep.
When people are less concerned, they come off very quickly to the downside, when there's negativity. And certainly that's what we've seen over the last few weeks. Now, the reality is we've added to our positions over this time. So the companies we own are Webjet, Corporate Travel, and Tourism Holdings. And that is our sheer belief that we think that all that money that you've seen invested in retail over the past sort of year and a half or so, as COVID started, will come back into the travel sector and in particular international travel over time. So look, while we are bullish on the retail sector going into Christmas, our viewers will probably look to lighten these exposures into 2022. And certainly we think the tourism sector as a whole will do very well. And we'll think a disproportion of a consumer's budget will actually go towards this sector.
So are you pushing more generally towards services then, away from goods slightly?
I think with the way we look at things at Wilson Asset Management, I wouldn't say we're looking at services versus goods or anything like that. It just depends whether it fits our investment process and we see catalysts to invest. So
Yep.
I think, I wouldn't say we have a preference for either really. I think the hard thing for those companies manufacturing goods at the moment is if they don't have pricing power and a very strong market position, it's very hard to offset the cost increases that we're seeing. Now that will come off at some point, but at the moment it's actually very difficult.
Stay with me, Oscar. We'll be back in a minute. I'm speaking to Oscar Oberg, Lead Portfolio Manager at Wilson Asset Management. So then what's the outlook for the telco and tech? And I'm grouping those two together. So again, outside the Afterpays and the Telstras of the world, so more in the mid-small cap area. Is that an area that you're shying away from somewhat?
We have a decent exposure there. We've got a number of small and micro cap companies within WAM Capital and also WAM Microcap. And I think what we've seen over the last few years, we've seen a number of new entrants that have certainly benefited from the rollout of the NBN and also some of the larger players in the telco sector, such as Telstra or TPG, being more focused on mobile and also being restricted from a mergers and acquisitions perspective. So we have shareholdings in Superloop, also Swoop and Aussie Broadband. And one of the companies we're most bullish on would be TPG Singapore, which came out of TPG. David Teo is the founder of TPG, has a significant stake here. And this is basically an emerging player in the Singapore market, which we think now has around 5% of the market after only launching 2 years ago. So that's probably our largest position in the telco space. On the tech side, I mean, look, it's gone from the hottest trade in small caps over the last 2 or 3 years to quickly becoming probably the most unloved trade in the last few weeks, given what we've seen with inflation, in particular in the US. But again, similar to retail, we're really focused on those tech companies that are going to benefit from a reopening of economies. So our largest holding within the fund is Life360, which is effectively an application for parents to monitor their children.
How do you think I keep an eye on my kids, Oscar?
Well, it's good to hear you're a user.
I am. So we've got retail, telcos, tech. We've discussed travel and tourism. What other sectors that you like or dislike?
Yeah, we've got a significant bet on the construction sector within the fund. So there's two elements there. Those companies exposed to infrastructure spending and also those exposed to building materials. It's been a tough sector for both these over the last, call it, year and a half. Both sectors have been hit hard by COVID lockdowns. But on the construction side, we really like Mars Group. It's the biggest position in the portfolio, which is effectively a construction company focused in regional New South Wales. We also have holdings in Adelaide Brighton, and on the building materials side, also Brickworks and Fletcher Building. In terms of the sectors that we have minimal exposure to, I think, we mentioned tech before. We have a very small exposure to the technology sector, as I said, so largely exposed to those reopening players. And I think on the retail side, while we are bullish on retail, I wouldn't say we've got the traditional retailers as such within the portfolio. A lot of the retail companies that we have are exposed to a reopening, so very stock specific there. So I guess, the beauty of Wilson Asset Management is, we do look at a number of sectors in industrial, so I wouldn't say we're sort of wedded to one or the other at this point in time.
Oscar, how do you keep across all the companies? And this is a serious question because you've just reeled off a number of companies, many of which many listeners wouldn't even have heard of. In fact, you mentioned the Mars, the regional building group in New South Wales, which I have never heard of, to be honest. How do you keep across all these smaller opportunities?
Look, one of my first bosses in the industry, actually, I remember when I first started, said, every night he would always look at the ASX announcements that were done across all companies every night as he went home at sort of like 6 o'clock or 5 or 6 o'clock after work. And I do that every day. It's funny. Sometimes you pick up on a company out of nowhere. I'll give you an example, was a City Chic. That was previously within Specialty Fashion Group, which was, a poor performing company for some time. And, I remember looking sort of after market, they announced a restructure of the business. We did a little bit of work on it, realised that City Chic was the jewel in the crown. I think, we were lucky enough to buy that stock at sort of around 20, 25 cents. And today it's, well north of $5. So Yeah, I think you can find gems, but I think the most important thing is you stick to a process, and that's certainly what we do at Wilson Asset Management.
Oscar, thank you very much for talking to Fear and Greed.
No problems. Good to chat.
That was Oscar Oberg, Lead Portfolio Manager at Wilson Asset Management. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.